Hey guys, what's going on? It is great to be back with you. I'm going to turn my ringer off so that it's not distracting to me mainly. That's all. That's what I'm most concerned about is if I get distracted here. But hey, it's great to see you guys, man. It's been a whole week. There's been a lot that's gone on. And I thought we would kick around some things that came from the Questions for Kevin channel in the Discord. So if you're not a part of that, you can go in the notes to this video and click on the Discord, join the channel. It is free, or join our Discord. It is free to anybody that wants to join that. We are nearly at 100 people in that Discord, and there's some really good conversations that go on there. We'd love to see you there. So just know that that's available to you if that's something you'd be interested in doing. And with that, I'm going to go ahead and start. Here's some of the questions that we got, and they're really good questions. I'm going to go ahead and pop up here on the screen. I don't know if you guys noticed or not, but the new name, which we talked about last week, got some ideas. But the winner of the new name for this branding, I guess you would call it that, is called the Wealth Circuit Investing Hour. So hey, we're going to talk for an hour, and it's about the Wealth Circuit investing portfolio. So here we go. I like that. Hopefully you guys too. But hey, this is kind of cool too. Just full disclosure: strategic dialogue for discerning investors. And so I went into some AI tool, and I said, hey, this is what I'm trying to do. Give me some words around that. And that's what it popped out with. I love it. So today we're going to have strategic dialogue for discerning investors. So that's why we're here, and I'm glad you're here. So we're going to see who all's on the channel here in a little bit. But before we get there, let's go ahead and hit some of these questions. So the first question that I got, I say the first question, I had gotten woefully behind in addressing these questions on the live stream. So I'm going to hit several of them tonight. I'm going to go pretty fast, but I've got some pretty concise notes here. So I thought I would hit at least maybe 2 or 3 of them, and then we'll have some open discussion. And then when the conversation wanes down a little bit, we'll hit some more of them. So but we're going to work our way through these things. So I'm glad you guys are here. Welcome to the program. So the first question that we're going to address tonight is, hey, Kevin, just curious your thoughts on SBUX. I'm sure everybody knows who SBUX is. It's pretty ubiquitous, and they're pretty much everywhere, basically. So here's some thoughts on SBUX. First of all, according to Morningstar, they are trading at a 16% discount. They have them at a fair value of $105, and their current price is around 88. I'm not sure how they did today. Today's the 29th, so I didn't look that up, but it'll be somewhere in that range. And they have an economic moat that is wide, as well as an exemplary capital allocation process. So Morningstar thinks highly of them. They are discounted. According to Morningstar's fair value. Also, I thought TipRanks has some pretty interesting stuff here regarding analyst expectations. And so take a look at this. You will see that, if they're trading around the $88 range, somewhere around the $88 range, the average of the analysts say that it'd be in 1 year would be $107. And so that gives them about a 22% upside. So that's not terrible either, right? I mean, we'd all love to have a 22% upside to our portfolio. And then just to kind of round things out, looking at Simply Safe Dividends, they have a yield of almost 2.6%, dividend safety score of 67. That's not terribly good. And then their last dividend growth was 7.5%. So they do have pretty good dividend growth. They've got a pretty high yield compared to its historical number, but there is a bit of concern. It is a safe dividend, but it's not where I thought it would actually be, to be honest with you. So here's some thoughts, some pros for SBUX. They have potential affiliations with companies like Pepsi and Nestle. And I believe that those can boost their international growth prospects. They have technological investment. They're talking about, having these made to order machines so that you get the drink that you want, that you order every time exactly the same way. Anytime you have humans making, your drinks, you might get a little bit more of this, a little bit less of that. But if it's a machine, it's going to be exactly the same every time. That could lead to better margins moving forward as well. Another pro is they got a pretty high return on invested capital. They're in the mid 30% range. They've got zero net debt. They do have debt, but they've got more than enough cash to pay off that debt if they wanted to. They have an incredible brand with proven pricing power. They have this is pretty cool. The loyalty program for Starbucks accounts for 59% of their sales. I found that to be pretty incredible. I mean, you've got people with an app on their phone, and those people are 59% of your sales. So that's pretty good brand loyalty there. So what are some cons? Some cons is that there is low barriers to entry into the coffee business. I mean, anybody can rent a little spot and start their own coffee business. So low barriers to entry, which leads to intense competition. They have the potential for wage inflation, and especially with what's going on in California recently. They got the $20 minimum wage there, and so if there is a lot of like these service businesses, a lot of their cost is in labor, and so if the labor wages rise quickly, then their margins could be under pressure. There's potential for wage inflation. We just talked about that. So operational risks are high as well. So if they are going to put all of this technology in and kind of reshape the way that they're going to serve their customers, then they've got to execute. They've got to be operationally precise, and they got to get that done. And margin expansion potential as well as menu development. So those are some of the cons. So those are kind of my thoughts. Bocce Man's the one who asked the question. I think. If you or if anybody wanted to invest in Starbucks, I don't think it's a bad deal right now. I think they're undervalued. I think there's some potential for them. I question my holdup is I question the level of growth that they will see outside of China. So, we'll just have to see. I think China might be a great growth market for them. And if that opens up, then, hey, it's going to be a nice little run for Starbucks. But at this point, I don't own any Starbucks, and I'm not planning to purchase any at this point. So, but those are my thoughts on it. I think it's a good company. I think if you've got it in your portfolio, I think, you may do very well. I just don't happen to own it and don't feel compelled at this point to buy it. So, Bocce Man, thank you for the question, my friend. We're going to go to the next one, which is this one came from, I think this is called The Trader. It could be the 3 Trader, but anyway, I think the 3 is meant to be backwards E. So the Traitor, and he says, where do you believe the market is heading? In which cycle are we at? And or at least your opinion about it. And depending on your answer, to hold dry powder or just DCA. So that's really all you're going to get is an opinion, because I'll tell you this, if anybody knew for sure where the market was going, that person would be very wealthy, right? So, I think none of us really know where the market's going to head. And I think that's my first bullet here is, I have no idea. I don't know where the market's going to go. So the question then is, where could it go? And I think we have some potential trajectory ranges. And I think we have a range for anywhere between, at least for the economy, to be anywhere between recession to stagflation to a soft landing, and it could be any one or somewhere along that spectrum. So I think it's still still to be shown where the economy is going to be. So I think we just got to move forward with what we know, and we've got to use good business principles, good investing principles to pick the investments that we want to have in our portfolio, realizing that we have a pretty wide range of uncertain outcomes. So, that's the point I will make there. What is the Wealth Circuit investing portfolio doing? Well, currently the portfolio is 97% invested, and I have about 3% of the portfolio, somewhere around $40,000 or so, that is really dry powder waiting to catch some opportunities. So that's where I am with the portfolio. If I were younger and not retired, I think I would DCA, and I would not hold a lot of cash, because even regardless of where it's going to head, if you're younger, you got plenty of time for that to recover. It could be bad, it could be not so bad, but you don't really want to miss when it starts getting good. So I would stay in, maybe DCA into stocks. However, in retirement, I choose to stay largely invested in solid companies that pay good, solid dividends, but also have the potential for growth. So that's the sweet spot that I'm looking for. I'm looking for companies that have a solid strategy, a solid, strategic competitive advantage. I'm looking for a solid management team. I'm looking for good capital allocation, good valuation, and great financials. And so when you put all that together, hopefully in the long run, we're going to win. And so that's kind of where I'm at, and that's what I like to do. So anyway, the trader, thanks for that question, my friend. And so now we are going to move on to one more question, and that is from NK. He says, "Hi, at Kevin Burgess. Would you give your thoughts on GGG after last quarter's report?" And yes, I would love to do that. GGG, which is Graco, is actually in my portfolio. So one of the things that I do when I listen to the earnings report, and I will tell you guys, last week, I don't remember how many it was. I think I had 9 or 10 maybe companies that reported, which is nearly half my portfolio. And I got another 9 this week. So a lot of work goes into this 2-week period of time. So that's kind of where I'm at. I am a little bit behind. I've got to think about 3 companies that I still need to listen to and document from last week. And then tomorrow morning, we're going to start again. So I'll just have to kind of work that through. I might not get finished this week. It might be early into next week, but I will keep tabs on what's going on, but I will do the full due diligence for every company in my portfolio. And GGG is one of those, and just so happens I've already done that one. So I thought I would share with you what it looks like. So this is what I put together. It's a little bit different for every company in the portfolio, depending on what they do and how the information comes across. But I put together, some snippets from their slides, as well as some things that I hear, some takeaways, and then I culminate that with, so what am I going to do about all of that? What does that mean? How does that impact the Wealth Circuit investing portfolio? So GGG is Graco. They didn't have a great quarter. Their sales declined in quarter one. Their earnings decreased $7 million, driven by lower volumes than expected. Their non-GAAP earnings were 65 cents per share, down 11% from the first quarter of 2023. Their gross margins were actually pretty good. They grew just a little bit. So the issue for Graco is volume. It is about companies buying the products. And so I think we are beginning to see that the tightening and the demand for products is beginning to wane. So we will just have to see how that plays out. This might be the early warning sign for what's to come here over the next few months, maybe even a year or two. Their backlog is down from quarter one, down from quarter 123, up $5 million from the previous quarter. They are introducing new products, and they talked about one of them on the call. It had something to do with using a drill to spray paint, and I thought that sounded pretty neat. but I've not seen it in any stores. So anyway, they're putting that demand out there. They're putting those new products out there, but the demand's kind of slow. GGG has a large product offering, is very similar in style to Parker Hannifin. Now, Parker Hannifin reports this week. I'll be interested to see how that goes. But their margins are holding up and their volumes are struggling. So what does that mean for the portfolio? It's currently 1.25% of the portfolio. The Morningstar fair value is $80 per share. My cost basis is somewhere around 76. So if it falls down to that cost basis, I'll consider adding more shares. But at the moment, let me see where it actually is here. I know you can't see this, but I am going to look for, it is currently trading at $82 per share. So it's still, if it goes down around the 76 range, I'm going to look to add some more to the portfolio. But for right now, I'm going to keep it right where it is. I think it's in a good spot for me. All right. So I tell you what, let's take a break from that and let's see who all is on the program. I'm going to go ahead and switch this over to here. Now you guys get to see me, which is, I feel bad for you guys. All right, so let's see who else here. We've got El Dynamico in the building. He says, good evening to everyone. Dude, it is great to see you on the broadcast, El Dynamico. Michael Swami's in the house. Good to see you, Michael. Shaping is here, and he says, don't forget to join the Discord. And I can't emphasize that enough. I can't tell you how much value there is in that Discord. So you guys should really look at doing that. So let's see, $ McDonald's. Oh, I wonder if that's McDonald's and Realty Income. I don't know. But that's interesting. I don't think I've ever met you before, my friend. So welcome to the program. And we got Pat in the house. And Pat's got a question here. Pat's wanted to know, what is my favorite sector? He says that his is energy. And I think my favorite sector, I'm going to give two answers. I think my favorite sector at the moment is utilities. Now, why is that? I think it's because when interest rates do begin to fall, I think we're going to see some price appreciation there. So I have actually raised my exposure to utilities over the past month or two or three. Yeah, I forget. But so I've got about 12% of the portfolio in utilities. So it is one of my favorite sectors. I think my favorite sector, though, just because of my background and my education, is the industrial sector. And it's because I kind of understand industrials. I have seen industrial work in action, and it is, just a part of my DNA. So I can really relate to the industrial companies, I think. So that would probably be my favorite. Doesn't mean it's the one that I'm going to invest the most in, but I like it a lot. So great question, Pat. We got Kevin Mendoza. Hey, he likes the new title. Thanks, man. I appreciate that. I think it's going to be kind of cool. I like it as well. So I appreciate you giving that feedback. Brad Durfee's in the house. Good to see you, my friend. So, smash the like button. Kevin Mendoza is wanting us to smash that like button. So I would appreciate that. If you would do that, that would be awesome. So we got the Candyman. The Candyman is here. It's good to see you. And Greg from Southern California is here. So Greg's in the Discord, as many of these folks are. And he shared some info the other day. I found it really interesting and insightful. So appreciate you doing that, buddy. Candyman is also known as Bocce Man, also known as Aldo. So he's the man of many names. So welcome to the program, Bocce Man. I hope you enjoyed the response to your question there from the Discord. So it's good to see you, buddy. Clayton is in the house. Good to see you, man. I haven't seen you around much, so I appreciate you joining in tonight. It's good to have you. on the program. And let's see what Al Dynamico says. When all of your positions are up, is it better to dollar cost average up or add a new position with a position that is undervalued? That is a great question. And I would say it depends. Every answer we have is it depends. But, from my perspective, if I find a stock that I have a big, what is that word that I'm looking for? Conviction. If I have conviction in the stock and it's not in the portfolio, I will go ahead and add or add a new position. And I did that here recently with United Health. It had a big hit, in price. And so I went in actually pretty strong with United Health, I guess more so than I normally do. Normally, I kind of dip my toe in and kind of work up. I now have, and I think I started this maybe a month ago, and United Health is about 3.4% of my portfolio now. So it's up there for me anyway. I like to be pretty diverse. So it's about 3.4% of the portfolio. And, I'm up about 8% in the last month. So that's not so bad. I could get used to that on a monthly basis. But so, I think adding when you have conviction about something, but I wouldn't add a new stock that you don't have conviction in just because all of your other stocks are up. If all of your other stocks are way overvalued, then, you might want to search for some other stuff, but that's typically not the case. Typically there's going to be something that can be around fair value. I don't mind adding shares at fair value. I mean, that's what the value of the shares is. It doesn't have to be undervalued from my perspective. I know if you're a value investor, you're looking for that margin of safety, but, for my perspective, it's worth its value. And so if I really like the stock and I want to build the position, I'm not opposed to paying fair value for some shares. So I think I would typically want to set a target for every holding that I have. And if I'm not at that target, I might pay fair value. I don't think I would pay over value for it, but I would pay fair value. And then if I don't have anything to invest in, I would do either find another stock that I would have conviction in, or I would pop it probably either into DGRO, which is the Dividend Growth ETF, the iShares Dividend Growth ETF, or I would put it into VU, which is the S&P 500. So that's kind of the way I do it. Doesn't mean that works for everybody, but it works for me. So hopefully that was worthwhile, El Dynamico. Pat says that Starbucks is Ryan's favorite, and yeah, I know it is, and it's a good stock. I'm looking forward to seeing what they do here in the future. So, but it's just not something that I'm compelled to invest in, even though it appears to be undervalued. I'm just not compelled to invest in it. I do drink Starbucks coffee, and I like some of the things on their menu, but it is not something that this, gets me excited. So, but I mean, it's a great investment. I'm not saying anything bad about it. I'm just saying that for me personally, I would rather invest in other things. So, Tutomi is in the house. Welcome, buddy. So he wants to know if we got any thoughts on CVS. I know CVS has had some struggles, but I haven't kept up with it lately. I know when I picked up those United Health shares, CVS was also struggling on the same news that came out. So let's do this. Let's look up CVS. I'm going to go ahead and switch this over so you guys can see what's going on. I have to stop that one and share a different screen, which would be this one. All right, there we go. I'm going to take your comments off of here. That's CVS. And let's just look at the chart This is the past year. Let's look at the last 6 months. They had a little bit of a struggle. When was that? Oh, it was right here. There's that big drop right there. And then it went down even further here. So, let's go a little bit tighter in. 5 days, they're up just a hair. 3 months, they're down about almost 8% in the last 3 months. So, from my perspective, let's see. Let's look up CVS and Simply Safe Dividends. Very, very safe dividend, paying almost 4%. So, it could be worthwhile. I'm tending to stay away from the brick and mortar, pharmacies and things like that, Walgreens, Boots Alliance, and CVS. I'm tending to stay away from those because as a long-term investor, I don't know, how long that's going to be a viable option. I think it's good for a while, but I think there's going to be some interesting innovations that come out that will kind of help in the distribution of pharmaceuticals. So I don't know anything. I've not heard anything, but it's just not something that I think I've got other places that I want to invest in. And United Health I was good with, but CVS just doesn't get me too excited. So hopefully hopefully that's helpful for whatever it's worth, my friend. So let's see here. I'm going to remove that. All right. So let's see what's next. Tutomi wanted to know about CVS. Oh yeah. Okay. Tutomi's got another one. What is happening with Whirlpool? They dropped heavy. Yes, they did. And Whirlpool is having some challenges, and it is challenges around demand. So, we saw that in Graco as well. We're seeing it in Whirlpool. Now, Whirlpool is doing some good things from a management perspective. They've sold off some of their assets. They have created some interesting partnerships overseas and created some cash flow that way. I will say this about Whirlpool, and I own a few shares of Whirlpool. Let me pull that up so I don't lie about how many shares of Whirlpool I own. So I own about 240 shares of Whirlpool. It's about 1.6% of the portfolio. I did sell some shares about 2 months ago, and which looks like a brilliant decision right now. But yeah, they took a big hit. I think they were up a bit today. Yeah, they were up 2.4% today. But they are going to struggle as long as demand struggles. So, I guess new homes is really a big piece of their business. They have new homes and they have replacement. So new homes, it's kind of slowing down. So it's really putting a hurt on Whirlpool. It looks to me from a financial perspective like they're going to be able to weather the storm and keep the dividend through 2024. But if we don't see things turn around for Whirlpool, probably third or fourth quarter of this year, I think it might be tough for Whirlpool and the dividend. So I think Whirlpool is going to be fine, but the dividend might be in jeopardy. I think it's going to be fine this year, but I think in 2025, if we don't see things turn around, Whirlpool might be a bit of a problem. So those are my thoughts on Whirlpool, Tutomi. Great question. I would love it if they were able to kind of work through this, but, it is what it is, right? And the management team is doing everything that I think they can do. I can't think of anything that I would want them to do differently. So they're working hard. They're doing the right things. It's just, they're just struggling with demand for their products. So, all right. Shaping's good to see you, buddy. Another con for Starbucks could be the unions, and I agree with that. I don't know. It's kind of wrapped up in the wage increase thing. But I haven't kept up with the union piece of it. I know at one point it was a big deal, and I think it's still out there. I just don't know. I haven't kept up with how difficult, or how much traction that union thing has. So hopefully that works out for Starbucks and their employees. I mean, I think there's two sides to that story. So if Starbucks can get that worked out and their employees are happy with the arrangement, then I think they can move forward. Otherwise, it's probably going to be a bit of a drag for them for a while. Okay, we got Bjorn. Welcome, my friend. Greetings from Thailand. Welcome, man, all the way from Thailand. That is so cool, and it's great to see you, my friend. So welcome. Candyman, Bocce Man. You bet. Anytime, my friend. Glad to do it. So Kevin Mendoza says he's excited for Papa Powell's big speech this week. I am too, but it's just going to be more of the same. I think we're going to see him not be really firm about anything. I think they're going to say we're going to be, they still plan to reduce rates this year. How often that's going to be and how much will be in question. When they will do it, I don't know. I know that if they don't do it in June, then they're going to really be pushing up against the election. And I know that they don't like to be seen as a political arm of the government, so they will tend to stay away from major moves right in that election cycle time frame. So, we'll just have to see where that goes. I don't expect much from him. I don't think they're going to lower rates at all in this speech. So it's going to be it's going to be interesting. So, but yeah, I don't think we're going to see much, and unless he gives some surprising thing, some kind of hawkish tone. I don't know that it's going to really move the markets. I don't think there's much that he can talk about this week that is worth too much. Michael, would be helpful to know what these companies do. GGG rings a bell, but I have no idea of its core business. I'm glad you said that. I didn't, because it's in my portfolio, so I automatically think everybody knows what Graco is. So Graco is a company that manufactures and distributes professional tools like paint guns and even fasteners and things like that. So they have this line of industrial equipment that's used for painting and construction, all the construction tools that are used. So Graco has a line of products. And so that's why when they have a product that uses a drill to spray paint a house, then that's a big deal, because if you just have to buy the wand or the spray paint apparatus and you just attach it to the drill that you already have, then it's a cost savings for the person doing the painting. So that's kind of what they do. So they are they have so many products. I mean, let's take Starbucks, for instance. Starbucks has coffee, and it has a menu of food items and some other things, like lollipops and, drinks and stuff like that you can buy. But their main thing is coffee, and their food, they have a hot food and a cold food. So, but it's pretty easy to kind of get your arms around. With Graco, they have such a large product offering that it's kind of hard to say, here's what they do. They have just this wide array of professional tools for construction, painters, that environment. So hopefully that's helpful. I tell you what, let me do this. Let me do this a little more professionally, and we'll just actually look up what it says in Simply Safe Dividends, and I will take you guys there. We're going to add that here. So, Michael, I'll take you off the screen for the moment. They design, manufacture, and market systems and equipment used to move, measure, control, dispense, and spray fluid and powder materials worldwide. That's quite a spray. When you can spray something worldwide, that's a lot of spray. The contractor segment offers sprayers to apply paint to walls and other structures, two-component proportioning systems that are used to spray polyurethane foam and polyurea coatings and viscous coatings to roofs and markings for roads, parking lots, athletic fields, floors. The industrial segment provides liquid finishing equipment, paint circulating, supply pumps, paint circulating, advanced control. You kind of get the idea. It is about this professional construction. Seems like there's a lot of paint there as well, like powder coating as well as liquid paint. Then they have a process segment that moves and dispenses chemicals, water, wastewater, petroleum, food, lubricants. So they have a lot of equipment that's used to move materials. So like paints that we were talking about. So that's what Graco does, my friend. So it's really a worthwhile company. I mean, if you look at the financials, they have some solid financials. I love the company. I love the strategy. They are just going to struggle until we can get this economy going again. And so we're probably going to hear that a lot in the industrial segment as we move through 2024. So, Michael, thanks for bringing that to my attention. That sometimes I just forget that everybody knows what I know. So I think that's human nature, but it's not good for a live stream. So there you go. All right. Let's see here. Michael says his favorite sector is NFTs. So there you go. That's a good deal. What about the least favorite sector? That's a good question. Tell you what, let me cheat a little bit, and I'm going to look at my diversification here. My least, the segment that I own the least amount of shares or portfolio that I have the least amount invested in is real estate. So my real estate investment trusts, I've pretty much gotten rid of most of those. And I've shifted that over into the utility space. Communications, I have a little bit, but not very much. Then consumer staples, I have Hershey, and that's about it. So those are some of my least favorite. And yeah, so those are my least invested in. So therefore, my least favorite. So let's see what we got going here. I'm trying to get... I don't want to be like my buddy Russ, who gets so hopelessly behind in the questions that by the time you kind of cycle around and you've responded to a question, it's hard to remember even what the question was. So I'm going to try not to do that. I'm going to try to stay up with you guys. So Jim Betts, he says, I've been watching from the big screen and waited until the wife got off the desktop to hop into chat. Good evening, all. So that is awesome, Jim. I mean, it's great that you have this big screen that you can see everything going on. That is so cool. So it's good to have you in the chat now, my friend. Let's see. Yeah, Tutomi hopes that Whirlpool recovers. I do too. And so, and I'm okay holding Whirlpool for another year. It's not, it's 1.6% of the portfolio. It's not, I'm down a lot on it, but it's not killing me. So I'm going to hold on to it, see what happens. Let's see. John J., do you have or like any REITs? And I did have some REITs, and I got rid of all of them, when they had a run back a couple of months ago, because I really wanted to focus in the utility sector. I understand that sector a lot. So, I wanted to stay in that sector. And to be honest with you, some of the REITs that I had very small positions in. And I didn't, because they had run up so much, I didn't want to invest more in them. So it was better for me to go ahead and liquidate those and move those into other investments than it was to try to average up in the real estate investment trust space. One of my favorites, though, was Digital Realty Trust, DLR. That was one that I actually made quite a bit of money on. And so I'm not really sure. Since I sold it, I don't really keep up with it, but I'm not sure where they are at this point. But they are in a great space, especially with AI coming along. So, if you can pick DLR up for a good price, I think it's worthwhile. Let's see here. So Jim says, at John J, marked safe from Nebraska tornadoes today. That's good, my friend. You stay safe, Jim, and don't let those tornadoes come at you, my friend. Gendry, it's good to see you, buddy. Hey, Kevin, you are a good man. Thanks for all the info in this channel. Well, I don't know so much about that, but I'm certainly glad to share anything that I know, and I'm glad you are here, my friend. Thank you for the explanation of GGG. Absolutely, anytime. Okay, so let's do this. I'm almost caught up now, and I see some other questions here. So before I get into those questions, I want to come back over. I'm going to get rid of this, and I'm going to go back to our presentation again. I'm going to share that. Take Michael off the screen. So the another question that I got, actually this came in today. See, today at 11:31 a.m. And this is from Sharon. So Sharon wants to know, do you have any thoughts on the recent dips in JBHT and ODFL? That's JB Hunt Transportation and Old Dominion Freight Lines. So, and to be honest with you, I did not. So I spent some time looking at them, and I thought I would share with you what I came across. Hopefully it's helpful to you. So JB Hunt, what I saw is that the revenues and margins are falling due to weak demand. They have high levels of competition. And when I look at the fair value in Morningstar, it's $171, trading currently around 162. They have a narrow moat and a standard capital allocation. Here I thought was kind of interesting. Analysts believe on average that the price will be around $211 in 1 year, which is about a 31% upside. So that's not so bad. And then we have, they have an 89 dividend safety score. So that's very good, very safe dividend. So, there's some competition there. I mean, if you can stomach that here during this economy. And one thing that I'll point out that I don't think I mentioned in any of these slides is that, there's a lot of, I guess, coming off the COVID, what is that called? The COVID pandemic. There was a lot of inventories that got built up because supply chains became so slow. They couldn't get the products. So they started just buying everything that they could, shoving them into warehouses. So what we're seeing now is a lot of inventory that was built up during the COVID pandemic being used by companies, and they're not having to buy that inventory. So they're trying to reduce their inventory levels back to normal, and therefore there's not a lot of shipping because they already have the products on hand. So I think that you're probably going to see that. So if you can stomach that, it looks not to be a bad situation for JB Hunt. Here's the Old Dominion story, though, and it's different. And so I thought I would share that as well. Old Dominion, it's a higher quality investment than JB Hunt, but also trading above fair value. Analysts are expecting tremendous upside for Old Dominion, and it may be due to the exit of yellow freight from that LTL. LTL is less than truckload freight. So Old Dominion is kind of the really strong in that area, and yellow freight, I guess, has exited that, and so therefore they are picking up some of that business. So let's take a look at some of this data. So it's trading at a 20% premium according to Morningstar. But here's the kicker, and this is what I want to point out, that the analysts believe that on average, and it's kind of covered up here, so I went ahead and brought this in, the average price target that the analysts have and there are 10, looks like 10 best performing analysts are saying that it's going to be $444.56 on average in 12 months. That is a 144% upside potential. So I think that's definitely worth looking into. I think, I would want to do more on understanding the Morningstar's fair value, because if it's, if the fair value is a bit off, then it might make sense. But this is a disconnect to me. We have a fair value according to Morningstar at $152. Analysts believe it's going to be $450. So what do we do with that? So I think Old Dominion is a higher quality stock because of, just the business, the side of the business that it's in and its financials. And it's got this huge potential upside from the analysts. So it's worth looking into further, I believe. And they have an 81 very safe dividend safety rating. They only have a 0.57% dividend yield, though, and that is way up from where it has historically been. So, but their last increase was 30%. That's actually pretty fast. So anyway, I think Old Dominion is worth looking into. I think JB Hunt, I'll back up here to JB Hunt. I think JB Hunt is a decent investment. I think it's, at a below fair value, so it meets kind of all the criteria. But there is something intriguing about this Old Dominion that I want to look a little bit more into. So there you go. That's so Sharon, I hope that works for you. And I would definitely be looking more at Old Dominion just to understand what's going on there. I will actually do that to see if I don't need something like that in my portfolio. All right, and this is the last question for the day, and so that's going to kind of get us to some of these other questions that we have. So Shaping is wanting to know, what's the difference between total common shares outstanding and diluted weighted average shares outstanding? Is it like warrants or stock options for employees maybe? And yeah, that's exactly what it is. So we'll kind of walk through this pretty quickly. But common shares outstanding are the shares that are currently issued and outstanding. So if you think about it this way, when there is common stock for a company, there is technically a common stock certificate. Now, today they are electronic. Historically, they used to be physical paper certificates, and whoever that certificate was made out to owned that certificate, which showed that they owned part of the company. So those are what they called issued and outstanding shares. You have a certificate in your hand. Today it's electronic, but you kind of get what I mean. So when they say earnings per common share, that is earnings for every issued and outstanding share of common stock. Diluted earnings per share includes convertible securities like warrants or convertible preferred shares. It includes employee stock options and also secondary offerings. So they may offer, for some kind of financing arrangement, they may offer some shares to be sold at a certain time for a certain price that has not arrived yet. So they have not issued and those shares are not outstanding. But a diluted earnings per share tries to take not only the issued and outstanding shares, but anything that could potentially be issued and outstanding as of the date of report to show you the difference between what it is, with the common shares versus if all of the shares, employee stock options, restricted stock units, all of that stuff were issued and outstanding, what would the earnings per share be? And then as an investor, we can say, if it's a big difference, then it might give us a sense for whether we want to invest in the company or not. So that's a great question. Earnings per common share show the earnings for existing and outstanding shares, while earnings, that should say per, there we go. You guys didn't see that, right? Earnings per dilutive share shows the earnings if all potential shares were outstanding. So hopefully that makes sense, Shaping, and appreciate that question. That was a great question. And all right. So now let's kind of get back to what we see here. Let me come back up here where I left off. I'm just reading some of these as I work my way back up. Let's see. Okay, I got you. Okay, Gendry. Oh, wait, we got to. Oh, there it is. Yeah. I've got 3 monitors here, and I saw something on one of them, and I thought it was actually me on the screen. So yeah, Gendry wants to know about Crown Castle. I think that's Crown Castle. I think Crown Castle is probably, they've come down a lot recently. And let's take a look at, we'll do that really quickly here. We got about 10 minutes left in the broadcast. There's a couple of other things here that I see that I want to get to. So we will, we'll hit Crown Castle here really quick. Let's do, going to stop that, and I'm going to share this screen here. Okay, let's get back to here. So we have Crown Castle. Borderline safe, 60. It's got a 6.57% dividend. Now, Crown Castle, for thanks for Michael Swami for helping me remember to talk about this. They are a real estate investment trust that invests in the telecom tower business. So these towers that you see for cell phones and microwaves and that thing, that kind of thing. They are an investor in that. They have not raised their dividend since October of 22. So that's good to keep in mind. They do have a dividend yield of 6.57%. It says here, January 10th. I obviously don't follow them, but they downgraded them a whole 1 point from safe to borderline safe, 61 to 60, because they buckled to activist pressure, adding uncertainty to their outlook. I think I remember that. I just don't remember the details. So, I don't know. I think you want a management team with some backbone, and maybe they buckled too soon for that. But you can see here that their dividend growth has been 0 over the last 5 years. They've averaged 8%. Let's one other thing, and then we'll move on. But CCI on fast graphs. Let's see where that kind of falls in. Yeah, you can see that it has come down quite a bit. It is definitely in undervalued territory according to fast graphs. Speaking of that, let's look at what Morningstar has for them. Yeah, they've got them at a fair value of $130. So they are 28% undervalued. So, if that's something that, based on what you see in the business, there may, here's the thing about being undervalued. In my opinion, there is usually a reason a company is undervalued. So what we as investors have to figure out is, what is the reason, and is that reason justified? Is that reason going to stick around forever, right? And so, if you find a company that's undervalued, you believe the market has it wrong, it might be worthwhile to invest in it. I don't know enough about Crown Castle to know why they are undervalued and whether it's justified or not. So it is definitely undervalued, and, it's a REIT. So, I just don't know what's going on with their business to be able to give too much more than that, Gendry. So hopefully that helps. So we got Gant in the building. Any thoughts on, is that Abbott, ABT? Let me take a look. I think that's Abbott Labs. Yeah, Abbott Laboratories. Any thoughts on them? It looks like they're a bit overvalued. Let me share what I'm looking at here. So this is fast graphs, and looks like they're trading at above where their earnings should support. So that's the way to read fast graphs. The black line here on fast graphs is here. There we go. The black line is the stock price. The blue line is the typical price earnings ratio that they trade for. The orange line is a 15 times earnings. And so what you want to look for, at least from a fast crash perspective, is for this line to be under at least where it has historically traded. So they are well above that. And so they're trading currently at a 20, almost a 24 PE, which looks to be a bit overvalued at the moment. So those are my thoughts. It looks to be a little pricey to me, Gant. So those are my thoughts on it. Michael Swami says the NFT comment was an imposter post from Meet Kevin. Well, great. Glad to hear that. All right. Tutomi says, any thoughts on CCJ? This is one on my watch list. I'm not sure who CCJ is. So let's take a look. Cameco Corp. Never heard of him. So I appreciate you bringing that up. But it also looks very, very overpriced. Looks to be somewhat cyclical in nature. And let's see what they do. Let's pull up CCJ. Yeah, it's got a very unsafe dividend rating. Hopefully this is the right one, but this is CCJ. So yeah, it does not look good from my perspective. So yeah, there's nothing about this that I think I would be interested in. Hopefully that helps too, Tommy. Just to comment on the Discord, this is Jim. I like the way it's set up with different threads for different topics. The other Discords I visited seem to be disorganized, free for all. I'm glad you like that. I tend to be organized by nature, and so it would drive me nuts to just have like an open free for all. How do you find anything? So I appreciate you saying that, Jim, and for I don't know how many times I've said this. If you want to join the Discord, just click the link in the comments. So thank you, Jim, for that comment. Honeybee, it's Sharon. So thanks for taking my question. Absolutely. Hopefully that was helpful, Sharon. I appreciate you asking that question in the Discord. And, I think that's a great way to kind of hear what's on everybody's mind. And now I'm actually, after all of this, caught up with the questions from the questions for Kevin channel within the Discord. So don't be shy. Go in and ask some questions. So I've got some material for next week. I would appreciate that. All right, let's see. Any thoughts about FTAI? One of my faves in my portfolio. To be honest, I'm going to have to look that one up as well. So FTAI, aviation. It is unrated, dividend of 1.65. Let's see what it's done recently. FTAI. I know my buddy Russ gives me a hard time about this, but I just don't like to give my thoughts without having something in front of me. So yeah, so looks like their price has gone up. So you've probably seen quite a bit of, wow, it's like doubled in the past few months here. So that's good. So I understand why it's one of your favorites, actually, Bjorn. So yeah, that looks good. It looks like it, is showing some signs of growing significantly. At least that's what the forecast shows in fast graphs. So, that if you can depend on that, I think you're in a good stock there. But they're unrated and Simply Safe. So. Okay, we got some thoughts here from John J. about Abbott. Their breakthrough dissolving stent receives FDA approval for arteries below the knee. That's good to hear. So I bet they're really excited about that. All right, Gant says ODFL had a stock split, so maybe numbers are off. Well, that could be, but typically these sites will adjust that pretty quickly. But you may be right, Gant. We'll have to kind of look into that, but it does look a little bit weird to me. My buddy Russ is in the house. I just worked at a JB Hunt last mile facility in Romeoville, Illinois last week. So that's great, man. I bet that's the reason that it's going to go up in price, because they will say, Russ from Dapper Dividends was here and he did some welding for us. So I bet that's what's going to happen, my friends. So yeah, that's cool. It's really cool to kind of see all this come full circle. There's actually tangible products there. So, Russ has got a question. Is there any time you would not use diluted shares, earnings, etc.? I typically look at diluted, Russ, to be honest, which I'm always honest, so I don't know why I said that. But anyway, I tend to look at diluted shares. I do want to know, though, what the non-diluted, the common share, the earnings per common share is, because I want to see what's out there in the wings waiting to be issued and outstanding. So no, I don't think there's any reason to ever look at anything other than diluted from my perspective. Let's see. Jacob's in the house. Welcome, buddy. I've been lurking and listening, but I just have one question. I was offered the ability to loan my stocks, and I was wondering what would happen if I did that. I don't think anything would happen if you did that. I had the offer to do that as well, but I didn't really follow up with it. I think they give you a bit of a premium to do that. So at the end of the day, I don't think it's a bad thing. I mean, if you wanted to sell those shares, I think you could sell them. I mean, that'd be the only thing that I would make sure of. I have not actually done it, but only thing I would make sure of is if, maybe some of you guys know, if you loan shares, are they held up for any reason when you're wanting to actually sell them? I don't think that they are, but let us know. I do remember the movie. This is Kevin Mendoza. I remember the movie Convoy. It was a trucking movie and had a cool song that went along with it. So, I will save you from singing that. But it's something that it was a movie that came out when I was a kid. So, man, it was a great show, great flick. Everybody loved it. Jacob's in the house. Welcome. So let's see. We got some discussion going on, which is good. Yeah, John Jay's going to give us some thoughts on stock lending. There is a small risk that a borrower could go bankrupt. Maybe the asset they borrow from you increases. So yeah, that certainly something to look into. What are the risks associated with that? John Jay, like PPG, that's I know it's a packaging company. I just don't remember maybe it's just PPG. Yeah, PPG Industries. So, it's a special chemicals. What am I thinking of? PPG Industries. Oh, you mean, I think you're making the connection between PPG and Graco. I think the difference would be that PPG would provide the chemicals themselves, and Graco would supply the piping, the pumps, the equipment to actually move that product. So I think that's the difference between those companies. Hopefully that's what you were asking, but yeah, everybody's talking about the Convoy song. Absolutely, man. That was a great song. All right, we're going to take, let me just kind of flip through. Oh, yeah, thanks. Thanks, Michael. So PKG is what I was thinking of. That's the packaging company. PPG is a special chemicals company. So, I mean, sometimes all these tickers, they just kind of run together. And especially after an hour where I'm trying to make sure that I'm still online and I've got 3 screens going on. And sometimes they just kind of get all jumbled up in my head. So let Let me kind of hit maybe one more, and then we're going to call it a day. We're going to go out with our favorite song. Let's see, Michael's got, if I recall the dividends, this is regarding loaning shares. If I recall, the dividends go to the borrower of shares, but a like-kind payment goes to the lender. Taxation may be different. Yeah, so it might be worthwhile to take a look into that. It's not something that was interesting to me. And so the last one on the list is from my buddy Gendry, who is screaming at the top of his lungs for us to take a look at CHRW. So this will be the last one of the evening. So let's take a look at CHRW and see what we find. CHRW. This might be something cool, kind of like ODFL. So C.H. Robinson's an air freight and logistics. It is a borderline safe dividend yield of 3.4%. They downgraded them in April, on April 5th. It says shipping volume and prices continue to contract. That's what we saw with JB Hunt as well as Old Dominion, pressuring C.H. Robinson's dividend coverage. So they have moved them from a score of 80, which is considered safe, to a score of 60, which is considered borderline. So it might be worthwhile to keep an eye on them. If you're not in it for the dividend, then maybe it doesn't matter. But they have grown the dividend on average 5% in the per year over the last 5 years, but they have not raised it since November of 22. So it is a zero growth. And you can see here it's been 6 quarters at the 61 cents. Let's take a look really quickly at the financials. Here's the issue. The issue is that the earnings payout ratio is climbing. It is well above 60%. So they are not going to be inclined to raise the dividend as that is going on. They're going to want this earnings per share to come back. And the only way to get that in the shipping industry is to get volume. And so we have to wait for that volume to come back. If you like C.H. Robinson, it might be a good time when I say it might be a good time, a lot of times it's a good time to buy a stock when everybody else is running from the stock. So that's why I say it might be a good time, because my guess is everybody's running from it. So let's look at this CHRW and fast graphs. It is, you can see here the earnings were, way up here. And so a 15 times earnings would have been like 114. And then all of a sudden the earnings just drop off of the cliff. And the share price has fallen, but not as fast as the earnings. So it looks like they're forecasting to be down for a while. So I think I'm waiting on that one. Personally, I think I would wait if it were me. Let's do, just for grins, let's look at ODFL here. Wow, Old Dominion is way overvalued. So maybe, we knew it was overvalued, but it is way overvalued. Even though it's come down quite a bit, it is way overvalued for what it's going to provide in the future. Unless there's this issue with yellow freight, and if there's going to be something that is not yet in the forecast, that could be it as well. And just for fun, let's look at JB Hunt. JB Hunt's also overvalued. So it looks like all of these transportation companies are overvalued, and it's probably related to the fact that their business is down. So, I would say proceed with caution on any of these, but if it's something that you like and you're in it for the long term, sometimes when everybody else is running away from a company, it's the time to buy in. So, so with that, I think we're probably going to, I'm going to just kind of scan through these here. But, I would love to stay on here for another 30 minutes, but, I think, I think that's going to be good for tonight, guys. So, I really love being a part of this community. I mean, you guys are awesome. And I really enjoy getting together with you guys every Monday night, talking about stocks. And, we got a lot of earnings coming out this week. I do want to show you guys one thing. Can you stay with me for just another second? And that is, look at Cummins. Here, I'm going to pull it up on tip ranks. This is a bit disturbing. Now, Cummins reports earnings later this week, but this was a bit shocking to me. I mean, take a look at this. It closed at 293.65. The after hours drops $55.68, down about 20, almost 19%. So hopefully that's a glitch. But hey, I mean, that's a big drop. So, I'm anxious to see what goes on tomorrow with Cummins, because obviously if that sticks, that's a big drop. Now, I have seen errors before, and so this might be one of those. But to drop from 293 to 237 in one day without any earnings announcements or anything like that, I think hopefully it's a glitch. I do own a few shares of Cummins. It is I don't know, probably 2.5% of the portfolio. So, but still, I still don't want it to drop 20%. That's a lot. So if you have Cummins, take a look at that, and let's take a look at the open tomorrow and see what happens. So I thought I'd pass that along. I thought that'd be kind of fun for those of us that own Cummins. So with that, I'm going to get out of here and give you the ending song. Here we go, guys.